Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. We finally had the October surprise. It came almost without warning, but as I go through the charts, we'll see some of the early signs, and a few of them I did catch. The trick is, of course, the timing, and it's usually not profitable or worth it to try to predict ahead of time when these kinds of things will happen. But knowing that suspecting and expecting that it happened at least had me mentally prepared. All right, let's dive into the charts. What you're looking at here is Swing Trade Bot, my favorite stock scanning tool. I just want to point out easily, it was a big down day. Short-term trends are all down. If you don't know the news yet, trade tensions between the US and China have exploded yet again. China clamped down on exports for rare earths. The president of the US did not take too kindly to that, called China hostile, and threatened significant tariffs. And this was in the morning. Now, it even took me some time to really absorb the implications of this as the market just sold off for the entire day. And the president waited until after market to announce just how high these tariffs were going to be. They are 100% on top of the existing tariffs. The deadline date is November 1st, which means, of course, he's giving time yet again for negotiations. But there's a kicker, which is these tariffs could go in effect even earlier if, I guess, the president isn't happy with how the negotiations unfold from here. Now, I'll just remind you that there's two things, actually, key reminders. And again, we'll see some of this in the charts. Number one is that volatility has spiked, and this is the beginning of the end of the drama. And two, the reason why this is the beginning and end of the drama is because at some point, the pain in the market becomes so much that policymakers or whoever else is involved in the drama can't take the pain anymore or wants to alleviate the pain in others and then reverses or does something to counteract. So I talked about this over and over again during the uh, tariff trauma drama the tariff, trauma, drama, and noise back in March and April. The same thing is going to play out here, but we have additional kickers, which is there's a lot of bad news going on right now that the market has just completely ignored for weeks on end. We have the government shutdown that's becoming as protracted as I feared it could be. Until today at least, the market completely ignored that. And sort of related to the government shutdown, we don't have the economic data that a lot of folks use to help calm their nerves about how the economy is doing. So we're kind of going to be flying blind here for a little bit, except for I think by edict, the BLS was commanded to go ahead and release the inflation numbers even during the shutdown. So all that to say is, while I still expect the regular cycle to unfold, of eventually the pain in the market will get bad enough such that policymakers will respond to counteract that pain. There's just no way to predict how long this is going to go on and how deeply it can go on. So take that as a caution. Also, of course, I'm presenting this as for educational purposes. Please invest and trade with your own time horizons and risk management in mind. And of course, there's no guarantee of future results. This is for informational purposes only. Now, if you have any comments or questions or feedback, put them down below. Like and share this content so the algorithm knows what's up. And of course, you can subscribe to this channel to get more. All right, let's continue down the page here to see the rest of the damage. This today was about as bearish as can be. Oh, I forgot to point out the big numbers. The NASDAQ, the S&P 500 lost almost 3%. NASDAQ lost 3.5%, and the Russell lost 3%. And again, we'll look at the chart soon to check out the technicals on that. There's a day that was about as bearish as can be, new lows over triple new highs. The bearish signals in swing trade bot soared to 5,600 versus only 1,000. So rarely see this kind of divergence in the bearish versus bullish signals, advanced versus decliners. Decliners, of course, overwhelmed the advancers. I'm going to show what happened with market breadth. You can see here with the heat map, just red, 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 red everywhere. Okay, so let's dive into market breadth. This is what I like to call AT50 for above the 50. That's above the 50-day moving average. Sorry, this is the percentage of stocks trading above their 50-day moving averages. I had been talking about this for over a month and a half or so, that I have not liked the way market breadth has waned and below the overbought threshold. If you recall, if you're a reader or a subscriber, you'll know that according to my AT50 trading rules, it's very bearish for market breadth to hover like this right below the overbought threshold and failing to get above it. Well, that's exactly what happened. But while market breadth was declining, the indices were going up. So we had this sort of divergence. Now, I never called it a bearish divergence because everything else in the market was just so bullish. But I just want to point out that once again, this signal matters, that if market breadth is not confirming the general direction of the indices, and particularly if it can't break out above the overbought threshold, which is at 70%, it's not good. You just don't know exactly when it's going to matter. As my trading mentors is fond of saying, it only matters when it matters. And today, October 10th, it really mattered. And what happened today with market breadth? It plunged. This is about as big a one-day plunge as you'll see. In fact, I'm going to go back. You can see it didn't even plunge this much during the sell-off going into the last tariff trauma, drama, and noise. The last time it plunged this much was back in December. Excuse me. Back in December, when the market had a bad reaction to that last Fed rate cut. Anyway, so we plunged, let's see, from 51% down here. Hopefully, just follow my cursor. So if you want to follow along with what I'm talking about, just follow the cursor here, down here to 40%. Sorry, 39%. And I like to call this area now essentially overbought in a bull market. We are in a bull market, so we are essentially overbought, but of course, it's not, it's only just beginning in that 30 to 40% range. And actually, sorry, this is not, it's getting towards overbought, oversold enough. Sorry, I'm stumbling a little bit there. Oversold conditions are at 20%. If we had this kind of selling that we had today, all it would take is, I think, another 2 days of this kind of selling, and we would be oversold in a flash. Now, the hope that everybody always has is after these days, we have a big gap down on Monday, which means prices jump down, have a big gap between Friday's close and Monday's open. And then that just washes out all the motivated sellers. And then we just rally up higher from there. Every time I look for something like that, it just doesn't happen. So I suspect what will happen is, so oftentimes will happen, is that instead of a big washout, people rush in to buy because they've had the weekend to calm their nerves and then to look at their stash of cash and start deploying capital, because we've been in this market with shallow dips and people just buying any and every dip. But again, this is just all speculation. It's, for me, it's wait and see what happens. Anyway, so this is a huge downdraft in market breadth. Back when I did more day-to-day market breadth tracking, I would call this a pseudo oversold condition because we had 2 straight days of strong drops in market breadth. So you can see here that also there was this additional warning of what was to come. You could see that we hit a new low for this downdraft on Tuesday. Again, follow my cursor to see what I'm talking about. And then on Thursday, it happened again. And again, I just didn't flag these things because I needed to see the actual confirmation. Today's selling Friday was the confirmation. Now, if we look at the percentage of stocks trading above their 200-day moving averages, what I like to call AT200, you can see that this nice hovering above this support line. I've talked about this over and over again. This is where AT200 was when the S&P 500 had its last all-time high earlier in the year. We've now broken below that. So I'm going to consider that also a bearish warning on longer term market breadth. So just to summarize, market breadth is looking bad. It's confirming bearishness in the market. And yet the two ideas you have to keep in mind is that, yes, that's bearish, but it's setting up the next buying opportunity. We just don't know exactly what that's going to look like. Okay, so let me change the scaling here and let's go into the indices. So S&P 500, like I said, it fell 2.7%, almost 3% in just one day. This is how bad the selling was. It fell all the way from just close to the all-time high, almost to the 50-day moving average support. So this is one reason why I suspect we are not going to get the magical gap down on Monday because the eager buyers, assuming they're still out there, are going to look at this and say, that's close enough to support. I want in. And you could see since this entire rally, the S&P 500 has barely even touched this support line, much less tested it. The one time it almost tested it was back here on September 2nd and it didn't quite get there. So this is a major move from a relative technical point because it's close to the 50-day moving average. And let's just say it's closer to the 50-day moving average than it is close in this entire rally. Okay. So that's very important. If we break below this, if we close below, it immediately puts this 200-day moving average line, which is the blue line. Again, look at my cursor. It's that blue line that would be put into play. I don't expect a very bad sell-off to get there that quickly, but that's what would be in play. Now remember, August, September, and October are the market's most dangerous months for downdrafts, and we just did not flush out enough selling in the downdrafts for August and September. Let me just remind you, in August, right on cue, we had a big downdraft, but it was only one day. It was 1.6%, and buyers stepped right in and never looked back. September, we had a near repeat the very first day of trading. But this time, because people, of course, expected the same thing in August, the buyers stepped in the intraday at the intraday point and rallied it back up to only a zero point 0.6 or 0.7% loss. And then again, we just kept melting up from there and never looked back. So again, if we're going to have to keep two contradicting ideas in mind, we have a lot of bearishness in the signals, but we're setting up for the next buying opportunity. So now think about if you're just someone who's just on automatic repeating patterns and are thinking, or if you're a robot or an algorithm thinking, hey, had a big downdraft in August, and that was the largest of the month. And then another big downdraft started September, and that was the biggest of the month. Now we have a downdraft that's bigger than any of those. In fact, we have a downdraft that's bigger than any month, I think, of this rally. And I'm going to let's just go to the monthly charts just to confirm that. I'm going to get rid of all of these symbols. Let's go to the monthly. Sorry, I'm taking a little bit of time here, but I think this is an important concept. Yeah, so look at this. If we were to close today, this would even be the first down month since the tariff trauma drama and noise. So we are down 2.2, let's just call it 2% for the month, and we don't have a single month below during this rally that was down. So this makes this a very significant moment. And a lot of, like I said, eager buyers are just going to jump right in because looks like a dip, just like any other dip that needs to be bought. And if I'm thinking about historical levels, and again, I've written a post about this 2.7% loss is around, I think, the median or the average maximum drawdown for October. The medium or maximum drawdown, I don't think is any worse than 3%. So from that perspective, we're also close to a point where I could justify at least starting to buy. So all that to say, keep these two sometimes contradicting ideas in mind. Things are very bearish short term, but this is setting up for some kind of buying opportunity. We just don't know how and when it's really going to take form and shape. All right. Now, after that preamble, let me go now to the NASDAQ, which of course looks very similar. Let me switch this to the day chart. Yeah. Let's go to the NASDAQ. And with the Nasdaq, same ugliness. It was a bigger loss, 3.6%. Now, unlike the S&P 500, the Nasdaq has been closer than today to its 50-day moving average, as you can see here. But and that was a pretty beautiful test, and the buyers, of course, never looked back after that point. So I think the Nasdaq more so than the S&P 500 is likely to hit this support before it bounces. That's just a guess. But just like the S&P 500, we have just had nonstop, practically nonstop buying or drifting higher ever since the recovery from the March and April tariff drama, trauma, and noise. And now we have the latest tariff drama, trauma, and noise. Now, I've always been going back to IWM. It's been my favorite way to play. And of course, it had a very ugly day, down 3%. And just like the other major indices, it's closing in on its 50-day moving average. Now, unlike the other two indices, the IWM has breached its 50-day moving average, but it did manage to cling to it. So for all three indices, the S&P 500, the NASDAQ, and IWM, the iShares Russell 2000 ETF, we're at a very important juncture where the 50-day moving average, again, it's this red line, is at risk. And what I want to see is yet another picture perfect test. That's what I would like to see. I don't need to see a big gap down that washes out the sellers and exhausts all the sellers. I'm going to be looking at this 50-day moving average line. Okay, makes sense? All right. Now, before I continue to the individual stock charts, let's look at the VIX. I did a YouTube short on this. If you want to deep dive on this, I'll just remind you that I talked in earlier blog posts and the video that the pressure was building with the VIX. You see this bowl that I drew, this purple line? My whole point was that the VIX was narrowing its range below this horizontal line. That horizontal line is where the VIX was, the volatility index was before it shot up into the tariff drama, trauma, and noise. And now we're having it shoot up again in the middle of the latest tariff drama, trauma, and noise. 20%, sorry, 20 is considered elevated for the VIX. We are above that. So the VIX is officially elevated. It's also it's overextended well above, I'm just going to call it this black line, this Bollinger Band line. So all that to say is we could, if buyers are super eager, this thing will reverse like nobody's business and go right back into this range. But um, if it continues higher, what I like to do is compare it to the last peak. So I doubt we'll get as high as it did back in March and April, but let's say it can at least get back to half of this range. So if things really get bad in the market, I'm going to project the VIX getting to between 35 and 40 before it tops out. And again, this is just a rough guess. Just because again, in that seasonal moment where October can deliver days like that. Okay. So this is the backdrop. This is the context. The VIX gives us this context. Fear is finally back in the market. All of this complacency has been wiped out in one single day. Complacency has gone, at least for the moment. All right, let's dive into the individual stocks because I want to first take a look at stocks tied to the consumer or close to the consumer. I had a discussion with a friend about why the stock market was doing so when the economy just feels so bad. Well, I said that yeah, the what's happening, of course, is that AI related trades and tech is really boosting the indices. But if you look at stocks that are close to the consumer, things are a little bit different. Now, XRT, which is the Spider S&P retail ETF, was also I think yeah all-time high. No, not quite all-time highs, but it had a nice rally. And look at this warning sign that we had earlier in the week. On Tuesday, XRT broke its 50-day moving average. The next day, it bounced, but it couldn't break above the 50-day moving average. On Thursday, it confirmed the breakdown. And I actually had XRT written down on my list for today to watch. And I just, with all the trading chaos that unfolded on Friday, I just forgot to look at it. But you can see here that XRT was one of the early warning signs that, again, market breadth was deteriorating very fast and undermining the underlying health of the market. So XRT fell 3.1% today. Now, another stock that's close to the consumer, Carvana. Carvana, of course, has had a major, fantastic ride from near death experience. But it looks almost like it's topping out. I don't want to call it topping out because every time people think it's dead, it's not dead. But what I want to point out, and sorry I didn't label it. Let's see if I could let me just put a quick shape over here so you can see this clearly. What I want to point out is that sorry, it's taking me some time to find it. There we go. Right here. after earnings, and hopefully you can see that, I put a circle here. After earnings, Carvana had a very great pop, 17%, and it was much higher on the day, but it faded from the intraday high, and then it continued to sell off from there. Now, like clockwork, it held its 50-day moving average for quite some time, and it drifted higher, drifted higher. But look at this. If you can see that I'm lining up the levels here, the Carvana started to stall out right at that all-time closing high. No, sorry, this closing high from post earnings, and it never got to the intraday high. So that was a warning sign. Carvana also, just like XRT, broke its 50-day moving average earlier in the week. That was on Wednesday, confirmed the 50-day moving average breakdown the next day, and then boom, today it's down 8.6%. Now, even with this big down day, Carvana is only, and I say put only in quotes, only at a 3 month low. And that just tells you how bullish Carvana has been. Okay, so anyway, that's another stock that's kind of close to retail and the consumer. Another one I want to point out, this warning sign I did catch, but ironically there was no follow through in selling. This is ticker symbol EAT for Brinker International. One of their restaurants is Olive Garden, and I noticed this on Wednesday, this big drop down. This was a 4.1% drop. Again, just follow my cursor. I'm waving it over the area that it broke down. And the reason why this is important, I'm going to scale back, is it made a new low for the year. And this was the prior closing low. And while there was no follow through to confirm this breakdown, I went ahead and got a put spread on this. It's kind of ironic that the one of the few places I decided to go bearish earlier in the week that had zero follow through with the rest of the market. But I don't expect this to hold up. Something is up here. I know Barron's. I saw a headline that said Barron's had issued a positive rating on Brinker, but this is just a very ugly chart, and at least I would not be buying into this. You could see this double top also. So this breakdown confirms the double top. You could even, well, no, it's not quite a Head and Shoulders double top, but you see it. Hopefully, you can see the visual here. All-time high, a lower high that didn't quite match up to the all-time high, and then drifting, 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 breakdown. Very bearish action, very toppy. Nike was one that I warned about in the wake of CarMax when I said that CarMax was a example of the danger that you can be in when you ignore downtrends. Well, I pointed out to Nike in upcoming earnings, and of course, what did Nike do? It popped 6%, 6.4% on earnings. It drifted higher, but check this out. Hopefully, you can see my cursor again. It's stalled right at 50-day moving average resistance, this red line. Just like magic, technicals working like magic again. And that was the warning sign. And what is this warning sign? Well, the warning sign is that Nike's downtrend is still weighing on the stock. Look at this downtrend. If you need a better look at it, I'm going to draw a trend line here for you. That is down, 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 no matter what tops you want to connect to. Um, And what was the result of this failure at 50-day moving average resistance? Basically, sellers have been in play for 5 of the last 6 trading days. Nike reversed all of its post earnings gains. That was another warning, bearish warning sign. You could have shorted here if you were bearish. And Nike also confirmed the breakdown below its 200-day moving average, which is the blue line. And now today it fell another 4.2%. And now it's working on giving back its post earnings gains from June. And that would be the target for if I were if I were interested in buying it, which I'm not, I would be looking to see whether Nike could at least hold its gap right here. Okay, so those are and then Abercrombie and Fitch. I wrote about this in a blog post, I think 2 weeks ago. I was kind of actually hopeful that Abercrombie and Fitch could eventually break out above its 200-day moving average. You could see it's had a bad time as well since about the peak of 2024. And unfortunately, Abercrombie and Fitch has just been extremely weak ever since it failed at the 50-day moving average. And the 20-day moving average is leading the stock and price action downwards. So it had a very bad week. It's now all the way back to the prices it last saw in May. So that's a about a five, almost a 5 month low. So I do not want to touch Abercrombie and Fitch, ticker symbol ANF, anymore. I'm just leaving it alone. Okay, so that's enough for the retail related stocks. Let's go to some tech stocks. I wrote about Albemarle Corporation. It did indeed recover, ticker symbol ALB. It did indeed recover technical resistance, support, broke back out. And but I just didn't like what I saw on Thursday, which is again this fade from a recent high. And then as soon as I saw the follow through selling, I just sold. It didn't even matter what the headlines were. This is a short-term topping action. I just took my profits. I'm happy with the profits I got, and I'll just keep looking for another entry point if the market so chooses to give me one. And you can see why I'm not hot to like press my luck is because yet again, here's a stock that was in a very extended, long downtrend. Yes, it's very bullish that it looks like it's reversing from bearish to bullish. But I just don't like the tenuousness of the trading now that it's broken out. Okay, so now let's go to um actually, you know what? Let's go ahead and look at Dell. Dell is, right in the middle of the AI trade. I wrote about Dell and how positive this breakout was. I was enjoying this big breakout on Wednesday as the AI trade really accelerated and now it's pulled back. I think, given what's going on, this is probably the highest that Dell's going to get for a while. I'm still going to hold on just because it's a core AI holding, but I just wanted to point out this topping action is probably going to be indicative of a lot of AI plays that are just exhausted for now. Another one of my core AI holdings is Vertiv. It's called Vertiv Holdings, ticker symbol VRT. It was up as much as 12% today, but unfortunately the selling really took the stock down. It was amazing it actually held its ground and closed essentially flat. But I also don't expect, I mean, I love how it's done this breakout to new all-time highs and continued higher. But I think for now it's probably going to stay stalled out. But again, it's a core holding. I'm going to keep holding it. Let's just end really quickly because I think you get the point. A lot of carnage today. I have commodities on my list to start buying up, and this sell-off is going to provide some lower entry points. Here's BHP Group. It's a diversified commodity company, has a lot of iron ore. It fell 2% today, 2.1%. It looks like it's probably topped out for the short term. The reason why I do like it is even though it's been in this sort of long trading range for 4 years, I think the pressure is going to start building to go higher, given governments are going to be scrambling to stimulate economies. And also the infrastructure buildouts that are going on are going to suck up a lot of need for commodities. Same thing with Rio Tinto, which I also bought today, ticker symbol RIO. It gave me an even better entry point, fell 2.3% today. It stopped at this 20-day moving average uptrend, so it's looking decent. But like BHP, it's also been stuck for quite some time. I'm anticipating that the time to break out is coming. It's not around the corner, but eventually it is, and I want to have some shares in place when it does happen. That's just my projection. There's no guarantee, of course. And I'm going to be accumulating on lower prices if the market so chooses. Okay, so that is it for today. There's hundreds and hundreds of charts, of course, I could have shown, but I think you get the point. There's carnage out there. You have to keep in mind two things that are at play. One is short term, the market is bearish. It's trading bearishly, but a buying opportunity is getting set up as we speak. If you're a short-term trader or swing trader, you need to just stay on top of what's going on. Try not to get overly excited about the headlines. Look at the price action, pay attention to technicals. If you're a long-term investor, it's still good for you to keep on top of things because the market is getting close to an oversold type of condition. And those oversold conditions are exactly when long-term investors should be deploying cash and capital into their favorite investments and stocks. All right. Again, if you have any questions or feedback, put them down below. Subscribe to the channel if you want more content like this. And please like and share the content so the algorithm knows what's up. Thanks for hanging out this long. And I will talk to you the next time. Stay safe and brace yourself for what's coming in the coming week and actually maybe for the rest of October. The October surprise is underway.